You're running profitable routes, good rider counts, solid broker relationships, but your bank account is empty. And in 90 days, you might be out of business entirely. Here's the brutal math that's killing NEMT operators in year one. You complete a trip today, let's say it's worth $40. You pay your driver $12, fuel costs $8, vehicle maintenance runs $3. You've got $17 in profit on paper. Except you won't see that $40 for 2 to 3 months. Your driver needs his $12 this Friday. Your fuel bill is due in 30 days. That $17 profit just became a $23 cash shortage that compounds every single trip. Most operators think working capital means having enough money to buy vehicles. Wrong. Working capital in NEMT means bridging the gap between when you pay for a trip and when the broker pays you back. And that gap is destroying profitable businesses faster than any operational mistake ever could. Here's what we're going to cover: the real numbers behind the Medicaid payment delay, how to calculate exactly how much cash you need before you take your first trip, and the 3 funding strategies that actually work for NEMT operators. Let's start with why the payment delay exists in the first place. Medicaid reimbursement flows through brokers, MTM, CTS, CareNest. When you complete a trip, you submit your claim to the broker. The broker has to verify the trip happened, check it against the member's authorization, reconcile it with their records, then process payment. That's not a 2-week cycle. That's minimum 45 days if everything goes perfectly. More often, it's 60 to 90 days because of reconciliation issues, missing documentation, or simple processing backlogs. But here's the part that kills operators: your costs hit immediately. Driver wages are due weekly or bi-weekly. Fuel costs hit your credit card within 30 days. Vehicle payments, insurance, maintenance, dispatch software, all of that runs on normal business payment schedules. So you're carrying full operational costs for 2 to 3 months before you see a dime of revenue. A single route with 8 daily trips can create a cash gap of $15,000 to $20,000 in the first quarter alone. Now let's calculate what you actually need. Take your monthly operational costs, not just the big stuff, but everything: driver wages, fuel, vehicle payments, insurance, maintenance, permits, software, your own salary. Let's say that's $30,000 a month for a mid-sized operation. Multiply that by 3 months. That's $90,000 you need in the bank before you complete your first trip. And that's assuming perfect payment timing, which never happens. Most operators dramatically underestimate this number. They think about startup costs, vehicles, permits, initial software setup. They don't think about carrying costs. The difference between those two calculations is why profitable NEMT businesses fold in month 4. They're making money on every trip, but they've run out of cash to operate while waiting for broker payments. Here's the funding reality. Traditional small business loans don't work for NEMT startups because banks don't understand the payment delay model. They see it as risky cash flow, which it is. But there are 3 approaches that actually work. First is factoring. Companies like Bluevine will advance you 70 to 80% of your outstanding broker invoices for a fee. It's expensive, usually 3 to 5% per month, but it bridges the gap while you're establishing cash flow. Second is equipment financing specifically structured for NEMT. Instead of buying vehicles outright, you lease them with maintenance included. This converts your vehicle costs from big upfront capital expenses to predictable monthly payments that align better with your cash flow cycle. Companies like Fleet Advantage specialize in NEMT vehicle financing and understand the payment delay issue. Third is revenue-based financing from lenders who work specifically with healthcare providers. They'll advance you working capital based on your contracted broker rates, not your current revenue. The payments adjust based on your actual monthly receipts, so they scale with your business. It's more expensive than traditional loans, but it's structured around healthcare payment cycles. But here's a real example of how this plays out. We talked to an operator in Georgia who started with 12 vehicles and solid broker contracts. Month 1, he completed 800 trips worth $32,000 in revenue. His operational costs were $24,000. $8,000 profit on paper, but his cash position went down $24,000 because he paid all his costs and received 0 broker payments. Month 2, same story. $32,000 in new revenue, $24,000 in costs, but still no payments from month 1. His cash position dropped another $24,000. By month 3, he was $48,000 in the hole despite being profitable every single month. Month 4. The first broker payment started coming in, but he'd already had to close because he couldn't make payroll in week 12. The operators who survive year 1 understand this up front. They raise working capital equal to 3 times their monthly operational costs before they take their first trip. They negotiate payment terms with drivers, maybe bi-weekly instead of weekly, for the first 6 months. They use factoring selectively for cash crunches while building reserves. And they track cash positions separately from profitability, because in NEMT, those are completely different metrics for the first year. Working capital planning isn't the exciting part of starting an NEMT business, but it's the part that determines whether your profitable operation survives long enough to become a sustainable company. If you're thinking about starting an NEMT business, triple your cash requirements and plan for 90-day payment cycles from day 1. Your future self will thank you when you're still operating in month 6.